What if I told you that saving money alone probably won't make you wealthy? Because while your money sits in a bank account, inflation slowly makes it worth less over time. That's where investing comes in. In the next 5 minutes, you'll learn what investing actually is, why people invest, the most common types of investments, and how beginners can get started safely. Let's make investing simple. What is investing? Investing is putting your money into something with the goal of growing it over time. Think of it like planting a seed. Instead of spending your money today, you use it to buy assets that could become more valuable in the future. For example, buying shares in a company, purchasing real estate, or investing in index funds. The key idea is this: your money starts working for you. Instead of trading time for money forever, investing allows you to build wealth in the background. Why people invest? One major reason people invest is inflation. Inflation means prices rise over time. Something that costs $100 today might cost $120 in a few years. So if your money stays in cash, it slowly loses purchasing power. Historically, investing in assets like stocks has helped people grow their money faster than inflation. People also invest for goals like retirement, buying a house, financial freedom, or creating passive income. The earlier you start, the more powerful investing becomes. Because of something called compound growth. That's when your investment gains start generating their own gains. Over time, small amounts can grow surprisingly large. Common types of investments. 1. Stocks. Stocks represent ownership in a company. When you buy a stock, you own a tiny piece of that business. If the company grows, the stock may increase in value. Some companies also pay dividends, which are payments made to shareholders. But stock prices can go up and down quickly, so there's risk involved. 2. Index funds and ETFs. For beginners, index funds and ETFs are often the easiest starting point. Instead of buying one company, you buy a collection of many companies at once. This helps reduce risk through diversity. For example, an S&P 500 index fund invests in hundreds of major companies together. Many long-term investors prefer this approach because it's simple and historically effective. 3. Real estate. Real estate means investing in property. People make money through rising property values, rental income, or both. Real estate can build wealth, but it usually requires more money upfront. 4. Bonds. Bonds are generally lower risk investments. When you buy a bond, you're basically lending money to a government or company in exchange for interest payments. Returns are usually lower than stocks, but bonds tend to be more stable. Risk versus reward. Every investment has risk. Higher potential returns usually come with higher risk. For example, stocks can grow quickly but also fall quickly. Savings accounts are safer but grow slowly. Good investing is not about getting rich overnight. It's about consistency, patience, and long-term thinking. The biggest mistake beginners make? Trying to chase quick profits. Successful investors usually focus on steady growth over many years. How beginners can start. If you're new to investing, here are 4 simple steps. Build an emergency fund first. Pay off high-interest debt. Start small. Even $10 is enough to begin. Invest consistently over time. Many beginners start with low-cost index funds because they're simple and diversified. And remember, time in the market is usually more important than timing the market. Investing isn't magic. It's simply using money today to build more freedom tomorrow. The earlier you learn it, the more powerful it becomes. If you found this helpful, hit subscribe for more beginner-friendly finance videos. And in the next video, we'll cover how to start investing with your first $100. See you there.